You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. I love that music because it means it's time for another episode of TWIFO, This Week in Futures Options, a program where the name pretty much says it all. Break down the week that was, and in many cases still is, from a futures options trading and trending and analysis and skew and volatility and all sorts of fun perspectives. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. You guys know how to get us. If you want to get us immediately, you like to hear it as you're at your desks or while you're trading, and you can head on over to the Mixlr link, mixlr.com, MIXLR, every Friday, 1:30 p.m. Central. Just grab that link, set it, and forget it. You'll be set for all of our shows throughout the week, not just TWIFO, of course. If you want to have it delivered on your schedule, then subscribe in your platform of choice, your iTunes, your TuneIns, your Stitchers, or if you want to do a deep dive into our archives, got some great stuff in there. Easiest place to do that is, of course, theoptionsinsider.com, or grab our mobile app. It's got it all baked in there as well. No limits. You can go all the way back to the dark days of our network if you're so inclined. No limits, all sorts of fun in there. I encourage you to do so if you haven't done so well. If you're new to the network, a lot of good stuff in there. In fact, we're talking about putting together a nice little best of feed to surface some of that stuff for you, because there is so much good stuff lurking there in the archives. And of course, however you listen live after the fact, if you go all the way back, or you're just joining us today for the first time, make sure you hit us up. Questions, comments, insights, pearls of wisdom we do indeed like to hear from you guys. You know who else likes to hear from you guys? Is my cohort here on TWIFO, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here once or twice called QuickStrike. Mr. Nick, welcome back to TWIFO, sir.
Hey, we were just here in a speedy show last week, and also looking forward to our hiatus next week. So I'm good to go.
Nothing excites Nick like a hiatus from the show. There we go. He gets excited. He gets pumped when his top hiatus. Of course, he's going to be traveling. I actually will be down at the Options Industry Conference, so he may have to go on a little best of next week. We'll get to that in a wee bit. But first, let me welcome on our guest. We are joined today by Jared Caplan. He is the head of commodities trading over there at Akuna Caplan. Jared, welcome to the TWIFO program.
Yeah, thanks so much for having me, guys.
And Jared, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give us a little bit of your background in the options and derivative space, as well as what the heck it is you do as the head of commodities trading over there at Akuna.
Okay, sure. So I'll start with Akuna. I'll first note, I guess all the ideas are my own, not Akuna's today. So we'll get that out of the way. But Akuna Capital is a young trading firm. So we were founded in 2011. We've got approximately 200 employees spread across, 4 offices now. We've got our home base in Chicago. We've got a Boston office, a Shanghai office, and most recently we just opened the Sydney office a couple of months ago. So our core competency here is providing liquidity as an options market maker. So hopefully helping out some of the listeners of this show get their trading done. So we're providing competitive two-way quotes where we're willing to buy and sell all day long. So to execute this, we design and implement our own low latency technologies, trading strategies, and mathematical models. We have no clients or external investors. We trade only with our own capital. So as the head of the commodities trading team, I guess my job breaks down into really 3 core responsibilities. So first and foremost, I have the privilege of mentoring and guiding our commodities market making team. So we've got 20 really talented individuals providing liquidity across the energies, metals, grains, livestock, and softs commodity space. My second responsibility is that I trade, maybe similar to some of your listeners, a relative value volatility portfolio across these same products. So we get a really nice synergy between kind of managing the market making, seeing what's going on, and kind of placing, I guess, longer term, lower frequency trades in that portfolio than we do in our core business. And then the third thing I do is I work with a small quant team, again, extremely talented, and we work on alternative strategies where we try and utilize unique data sets, data sources to forecast markets in both a high frequency and a low frequency capacity. So that kind of takes you through what Akuna is all about, what I'm doing today. I got my start trading in the pits. So I was in the currency options. I know Nick was a Eurodollar trader himself, so missed the good old days. Plenty of fun yelling and screaming for a living, but trading on the screen isn't so bad either.
Yeah, you're a whole crowd of degenerate former pit traders here. 2 CME guys. I escaped. I was over there in the SPX pit on the SIBO, but very, very similar crowd nonetheless. But let's get into it. I know, Jared, you're kind of more of an ags guy, so I think we'll kick things off there. It's kind of fun for us because we don't as frequently get to rotate the ags into our rotation, so it's always a nice break for us when we get to do that. By the way, listeners, you guys can, of course, always follow along, generate your own reports for free over there at cmegroup.com/TWIFO, TWIFO. You can see exactly what Nick and I and Jared, everybody are looking at throughout the course of the show. If you want to say, hey, what were the hot strikes or were the open interest changes or the big trades out there, and pick your product, soybean meal, whatever it is that floats your boat, you can do that, cmegroup.com/TWIFO. Remember, if you're listening after the fact on the podcast, make sure you change those expiration settings, those date settings there, so you get the what we're talking about here on the show. Otherwise, it might be a little bit confusing. But it has been an interesting week out here, Jared, for a lot of the ags out here. I happen to have corn up on my screen right now, but, coin finishing the week up a little bit still, but overall kind of a sluggish end to the week for a lot of these products. People looking at different areas, corn, soybeans, I don't care where you're looking, seeing that the pace of actually planting these crops kind of lagging what they expected last year. In fact, USDA, reporting earlier this week on Monday, U.S. corn crop about 5% was planted as of Sunday, and as of Sunday, soybeans are at just 2%. So both of those are behind last season's pace, which we know is a big driver out there for the ags. Before we even get any further, maybe we'll start with this. Which would you say, I know you say you focus on the grains and the oilseeds market. Which would you say, if there is one, is your primary go-to day in, day out market?
All of them. For sure, corn and soybeans are kind of our stalwarts as just the big products. You're going to have the most trade, the most open interest, theoretically the most opportunity. So, those are the two markets that I follow the most. With that said, interestingly enough, I think it's the small markets right now that are the most interesting for me, the Kansas City wheat and the soy meal. But I'll note, just talking about that 5% pace, that is hovering around the slowest ever in terms of corn planting. So I think that's pretty interesting. I think, and that has tons of implications. I don't know if you want to jump on into that or not, but I think that's the biggest story in corn right now, and then that'll flow into the beans.
No, let's get into that, because that's, of course, a big driver. People, in fact, I think we have some listener questions later about this kind of exact topic, about what some of the big fundamental drivers are out there in terms of corn. So, yeah, walk us through, those kind of, a lot of the listeners probably are not as familiar with the planting schedule for the ag. So, walk us through some of these levels, what you would normally expect around this time, and how this is impacting the prices out there.
Okay, absolutely. So, for context, we've got to take a step back and think about where we are and how to kind of utilize historical data. So I think the trade in general is really questioning, what does the slow pace mean? So we've got to go back to the high prices in 2012. And we've got to recognize that along with those high prices, we had a really cheap U.S. dollar, which made, kind of pushed our prices even higher, made our product really competitive on the world market. And a lot of the farming community took out a lot of investment. They took out a lot of loans, and they invested heavily in technology and machinery. So we've got kind of, what I'm saying is the world today, the world post, kind of 2012 is a world with, better data, more machinery, more technology. So we're using satellite imagery, and really the whole commercial farming has just stepped up their game a little, and that's led to lower prices as well. So, I think there's just a lot of uncertainty of what it means to have slow planting. So the trade is kind of unsure how bullish, how bearish this is, but, what does this mean? A lot of people would think that we can get this corn into the ground really fast. Maybe we can get this corn into the ground in a tight 2-week window. So what's the implication of that? If we get it into the ground, it gets planted, great. Everything's hunky-dory back to normal, but not precisely. What we're doing by getting the corn into the ground in a really tight window is, when it comes to pollination time, all the corn is at risk in a really tight window. So if we get a drought during that crucial time, or we get a flood, or it's too cold, we have a really high impact. So I think it kind of sets us up potentially for higher volatility later in the season if this plays out that way. If we get it really delayed, what we'll see is the possibility of rotating some of those acres into soybeans. And so that could be a bullish story for corn, put a bit of a lid onto the soybeans. And I think that's really, quite interesting there as well. So we kind of have a few different stories playing out over the next few months.
So, Jared, I got a question, and I think this comes up in being somebody who's new to ags in the last couple of years, last few years, as we've tried to cover it with Quick Strike. I'm always looking to get a little bit more information or explanation about the planting and the harvest. So the stuff that's getting planted now, is that will be considered part of the December contract for corn? Can you talk a little bit about old crop, new crop? Can you go through that?
So old crop, new crop is kind of the traditional way we looked at grains for CME products, and from an American U.S. perspective. So for a very long time, probably, I don't know, many, many decades, my history doesn't go that far back, America was or I should say the United States was the dominant player in grains. So we'll plant, right about now, and we'll harvest before the December contract. So, kind of a September harvest more or less for the corn. And with the soybeans, it would be July, and then for the old crop and new crop would be November. So everything that you're trading out to the July expiration is kind of the old crop. That's what we took out of the ground, from last season, and that's what we have, and that's what we're using. And then the Nov beans, Dece corn will be the new crop, if you will. This has become a little more complicated because now we have more of a world production with South America coming into the picture. So South America has, they plan a little bit differently. They'll do a double crop, but at the end of the day, they have, you could say, like the May expiry is, the South American crop, if you will, or the July expiry could be the South American crop. So it's not necessarily anymore, U.S. old crop, U.S. new crop. It's almost, South America crop is that May, July, depending on which exact, crop we're talking about down in Argentina and Brazil. And that Nov Dece is kind of the U.S. new crop. So we're kind of, in this world market. And that world market has really helped lead to those, short-dated, kind of like the mid-curves. And we've got short-dated new crop, and I think they may soon list South American short-dated with that May, July being kind of that key underlying. Is that clear? Or
yeah, no, that's good, and that kind of leads me into the. I had a short-dated question as well because the big change that we made years ago, and I was on the floor, was the short-dated or mid-curve options, right? So it's the same name for the different thing. But I'm looking at the open interest on this. So do you utilize the short dated on the December contract right now? Do you do that much? I mean, it looks like it has a similar, it's kind of call heavy like the December contract is. But are you guys trading that? Do you actively look to trade that and spread that against the December contract?
I think we'll be, if not the largest liquidity provider in those short dateds, in that top group, top 3 liquidity providers. So we're quite active. If you're seeing two-way markets on the screen, that's us. If you're calling down into the pit and getting a market, you're, Brian Purvis in the pit for us is making a market in the soybeans, Tom Mahoney in the corn. So, whatever your venue is, it's, we're active. As are some of our competitors as well.
Speaking of that,
and then Mark, one more thing, just if I could follow up on that. Mark and I always have the same question when we look at a lot of the commodity products. There are obviously weeklies on these contracts as well. Do you see them picking up steam at all, or is it just too short dated for some of these guys? This corn stuff.
You're saying not weeklies on the short dated, but weekly
just the straight up weekly options. Yeah, I mean, because there's barely anything out there. What can you tell us about why you think that is?
I mean, they're less liquid. I think liquidity prefers to center on those standardized contracts. So we have a ton of interest in the July, the old crop. We have a ton, the most interest in the November, December, in that new crop expiration. So, liquidity more or less begets liquidity, where if you've got a tight, size market, that's a great place to trade. I think there is lots of interest. I mean, we saw, today's expiry, the week 4 options was trading today in the corn. I saw 800 lots trade early in the pit, maybe 400 lots trade later in the day, electronic on Globex. So the weeklies are trading. You'll even get some weekly action in the soy meal, which is an illiquid market, but that's relatively thin. So, I mean, relative to your serial quarterlies, they're not exactly quarterlies, I guess, but it's thin. But I think there's still great liquidity. I mean, your markets in terms of, price and vol bips are really tight. I mean, the liquidity in the weeklies in 2018 are significantly tighter than markets we were making 3-4 years ago in our biggest, tightest expirations. So if somebody's interested in a weekly, I say go for it. You know, the risk reward is solid.
Yeah, because that's always we're always running up against that because we feel like you get the regular contracts, and as they wind down towards expiration, there's plenty of activity in those contracts. So we always wonder why we're not seeing that same sort of activity or open interest or just flow. I realize the markets are tighter than they have been, so it always is sort of head scratching as to why we're not seeing the same sort of open positions or flow in those contracts. So we appreciate that answer. And then finally, one thing that I have some people that I follow, and you hear a lot of complaining from the pit guys about the introduction of block trades into the market for the ag. So I'd like to get your take on that and whether you think that's whether you're good, bad, or indifferent to that whole situation.
Absolutely. So block trades are terribly divisive. If I come out for or against it, I'll make tons of enemies. So you're putting me in a tough spot, but I'll give you my honest.
Give it. Just talk. You could talk to both sides. That's right.
Yeah,
that's fine.
I'll give you my honest opinion. We trade a lot of blocks in other markets. I mean, blocks are trading, massively in the energies. They work really well. We do a ton of crosses in the ice softs commodities. So, I mean, blocks and crosses are two new venues. We've traditionally had only two in the ags. We've had the pit and we've had Globex. So the introduction of these two new venues have created some concerns for some people, and they've relieved concerns for others. There's a reason that CME introduced these because there was a demand for it. A block trade is really useful for tremendous large size transactions, in my opinion. The crosses is valuable for the reasons it's valuable as well. We participate in the pit. We participate on Globex. We participate in blocks, and we do participate in crosses. And I think it's up to the customer and the broker to identify, we've got 4 great venues that can work. And we've got to identify, like, with this particular order, where am I going to receive the best fill? Where is the absolute best liquidity in terms of depth and width for this particular order? And that answer is not always Globex. It's not always pit. It's not always cross, and it's not always block. But so there are definitely right uses. I mean, we have seen orders go through where we think that somebody chose the wrong venue. I'm not a broker, so unfortunately I don't get to pick the venue. We're just making markets in all of them. And I think we've done, great fair trades in all of them, provided a tremendous amount of liquidity. And, hopefully the business is growing because of these venues. I think what a lot of people don't consider as well is there's a 5th venue, and I think that 5th venue is pure OTC. And hopefully adding these 2 venues allows us to bring some of these dark OT transactions, into the light and into these 4 great ways of doing business. And I think that will ultimately be a terrific thing for the institutional customers. The biggest end users of grain in the world, I should be coming to CME Group. I honestly believe it's whatever their headline is, a place of great liquidity, great transparency. The largest producers hopefully are coming and hedging, and I'd love to see the largest speculators playing around in the sandbox as well. So hopefully these 2 new venues achieve that. So I guess you could say that I'm pro in the right, in the right moments, in the right conditions. We're very active in the pit. I grew up in the pit, love the pit. I have seen, less than great things happen in the pit. I've seen less than great things trade on Globex. I've seen less than great things trade on the blocks, unfortunately, and go up on the crosses. I mean, it's just what it is. But all in all, I think this is a positive move by CME. And as long as the traders and the brokers continue to do the right thing for the end user of these products. How does that sound to you?
No, I I like that answer quite a bit for a number of reasons, because only people that were ever in the pit, because mostly what I see online is complaints about the blocks, right? So you made two good points, which I think we should follow up with closing statements on those. So first thing is, for every time somebody complains about a price that they don't like on a block, there's as many, if not more times, that there's been bad price or sniffs of prearranged situations in the pit. So anybody who has experience knows that nothing is perfect, and there's always the tendency for something like that to happen. The second thing, which I think that a lot of these people that are complaining about it, and again, I'm an agnostic. I'm not on the floor trading anymore, and I'm just more observational and just trying to present the information. But I think a great point is the fact that most people want to look at these blocks and say, oh, this is just somebody trying to beat the system, when in reality, we don't know if it's somebody coming over from the OTC market. And you making that point really puts it on, it could be liquidity that never even was provided before by the floor. And now, given that the blocks are there and people can come in there and maybe get a little bit better price for bigger size, that could be something overflow from the other market, or them testing out that market. So I think that's a great point. And I don't think that's anything we ever brought up in terms of the blocks or the complaining or talking about. It's the fact that it might be a transition from one market to another.
Yeah, absolutely. I mean, I see that as really the key reason to do this, for CME. They're trying to grow their market share. I've spoken to some very large end users and producers, and there's reasons that OTC market exists. It has some competitive advantages. I don't take part in it. I'm partial to the CME model. But anytime anything changes, there will be growing pains. We recognize that. We're working through it. Not everything we see fits us. We didn't come out of the gate asking for black trades and crosses. This is increasing our kind of the human capital expenditure that we have to spend, because now we're providing liquidity in 4 venues. There's tons of pros and cons to all of this, but there's a good reason for some of these trades to be happening. Is how I'll leave it, I guess.
Nick, we've been doing the show together for a while, and the second I open my mouth for discuss the weeklies, you're already way ahead of me talking about that topic. But you're right. There's so much to break down out there in the world of ags and volatility, and even a little bit of controversy, which is always fun for the products out there. People get up in arms. They have their silos of liquidity that they prefer X over Y over Z, and they won't budge. Maybe it's irrational, maybe it's rational, but we all know how that works out. Whenever they add new venues, things tend to be a little bit rough at first. But at the end of the day, usually more liquidity is a good thing for more people. Let's dive into some of what we're seeing out here in the corn options. By the way, again, you guys can follow along. CMEgroup.com/TWIFO. Just select the ags, select the corn, and you're off to the races. You'll see that it is a pretty deep and liquid product. Like I said, end of the week, kind of weak on the ags, but still corn ending the week strong, up about 15 handles, threatening that nice even 400 level out there, up nearly 3.5% net on the week. So net, despite some weakness towards the end of the week, overall a strong week for corn in terms of overall volume. Also for vol too, vol popping up pretty strong out there across the board, multiple handles in some respects, looking across the term structure out there. Also strong from an OI perspective, net OI up over 7%. That's a pretty rock'em sock'em week out here in terms of corn options. If you're asking to yourself, where would be the number one corn option strike, the hot options number one with a bullet out there? If you said the July 400s, then you are a winner. It was a close race this week. It was a hotly contested battle, but the July 400 call, people like those nice even number strikes. Just go figure. Doing about 22,000 this week. The lion's share coming actually on Wednesday with about 10,000 going up there. So just about half going up on Wednesday. The rest kind of scattered throughout the week. A lot of back and forth, about net close to 5,000 net opening on that strike. Then we actually have to drop off a little bit for number two. Again, it was closely contested. Everybody loves the 400s. They also love them in June. The June 400s lighting it up to the tune of 21,500. So just slightly in the number two spot with about 8,000 actually going up on Tuesday. That was the lion's share out there. The rest pretty evenly scattered throughout the week. About 4,000 net opening there as well for our number two of our top 5 big hot corn action pack strikes here. Number 3, the 390. So at 400, a little bit too bullish for you. The June, what are these? Actually, these are July for the July 390s, doing about 18,000 contracts and change. The lion's share again coming on Wednesday with about 7,100 contracts. Net about almost 4,000 opening there as well. Then we kind of drop off a little bit again for our number 4. Actually looks like it's going to be the 390s back in June and July, 390s and 400, dominating our top 5 here today. About 14, almost 15,000 of these June 390s going up. The lion's share again back on Tuesday, about 6,300. Net again, almost 4,000 opening. So maybe some a little bit spreading maybe going on between those. I'm sure Jared could probably speak to that in a little bit. And rounding out our top 5 here for corn, if you're saying to yourself, the 400 strike is just not doing it for me. It's not optimistic enough. Well, then we got you covered. Our number 5 on our top 5 options list here, where these July 480s, yes, 480 calls doing a ton of paper. Actually, all of that coming today pretty much. About of the 13,500 contracts, about 10,000, 9,900 going up today. Obviously, we don't know the OI on today's paper. For the rest of it throughout the week, about 2,500 kind of net on the week. So it has been a active week overall here for all things corn. Let's just do our scans as we were wont to do, see if we find any little funky strikes lighting it up. There were some interesting strikes going up out there in terms of the SEP. The SEP, if 480 doesn't do it for you, then the SEP 500's got you covered. Nearly 9,000 going up this week. About 6,000 of that, pretty much all of them on Tuesday. Net slightly closing on the week, actually. So someone perhaps deciding 500 was a bit of a bridge too far and taking that off the table this week. Let's see, 390 puts doing some slight action out there. That's let's see as we scan here through some other funky strikes. Looks like that's kind of it on the funky, outlandish strike list. Mr. Nick, I know you've been watching the Ags vol. You're becoming quite the Ags head since we started doing this show together. You're getting lured to the dark side of corn and beans and everything else. So what was catching your eye out here from a vol perspective and a skew perspective this week?
All right. So first, I'm going to ask Jared for a favor, then, and then I would just like some constructive criticism after that, if that's okay. So we got a deal, Jared? Can you?
Yep, sure.
Okay.
I'm into it blindly. Let's go.
Okay. All right. No. So basically, I just want to get your take on, if we go at a straight up look at the money volatility this week by looking at the report, and I don't know if you're looking at the report with us, it looks like vol is up. Okay. But when you look at us being up 15, and then you look at the vol curve where we started last week and where the vol curve is today, we're really, would you agree that we're really not, vol's higher, but we haven't had much of a change in the structure of the volatility curve? Would you say that's fair? I mean, is that something that you guys watch and say, yeah, we got, if you do this straight up, hey, at the money vol is up, that's one thing. But the reality is, if you look at the 400 strike over the 400 strike last week, we're probably not up that much, if at all. So would you say that the ag market, or the corn in this case, may just sort of shift around the volatility curve, the point move along the line as the futures move, without much actual vol change? So, okay.
We've had this week's been very interesting. Just some tremendous buyers and tremendous sellers. So you're right. We're more or less unched, and I think some of the more interesting things might be in the shapes of the curves, or the skews, the kurtosis, whatever you'd like to call it. But I'll agree for now, and I'll hold my tongue and let you continue on. Okay, good. So that was the first thing, because that's one thing. Sometimes we get a little bit narrow focused on here, in that we mention volatility being up, and just from the old days, we gave straddle runs and people were just looking for at the monies, and there wasn't much mention of, just it being a shift along the vol curve. So the next thing we usually talk about is we talk about skew, and we generally look at the 25 delta stuff, but we don't necessarily just straight up do the call minus the put. We have a measure called quick skew, which is essentially a percent difference from the at the money for the existing 25 delta put and call. So so this week we don't see there's a dog in the background in the office next to me. If you hear that, I apologize. We don't see
don't see much. And I have another options question for you too. In general, we don't see much in terms of the change in percent relation from the 25 delta put to the at the monies, but we do see a little bit of an offer in the calls in comparison to the at the money. So that's pretty much what we're seeing across the board, and probably even more so in the early short dated option. But not much change. I think from my perspective, it looks like the shape of the curve hasn't changed all that much. We obviously have a bid to the call side. We had more of a slide along the move up, so we didn't see too much of a change in the skew. Just from looking at the numbers and just kind of comparing one picture this week to the picture last week. And then I want to follow that up with throwing it out to you. In general, where you guys think, and I could look at the open interest wise, but just from a practical standpoint, if you could tell our listeners where you would, where the focus of the trade is. Is it usually in the fund contract, or is it in the first three contracts? So that kind of thing. So I'll throw that out to you and see what you have to say.
Okay, I mean, it's really interesting what you've mentioned. So I guess we'll start at the beginning. Where has the vol smile gone? So some of the contracts we mentioned, for example, those Step 5 calls were paired up with the June $4. Those traded in the pit on Monday, I believe, maybe Tuesday. But today's session and yesterday's session, those July 480 calls you mentioned that rounded out the top 5, those were all buying interests. Those were paired up with the $5 calls as well, and I think they traded another strike. So 2 days in a row, those were morning buys. What's interesting about the skew, and unfortunately I don't have my tools in front of me. I can't remember if July or September, so as far as grains go, July corn skew is the highest skew on the board. So it's already quite rich, and when I say skew, I mean however you want to calculate it, but the value of the calls versus the at the monies. I won't go quite into the methodology I prefer, but that July call skew was if that wasn't the highest, maybe the September is. So we had a lot of buying. You're definitely right on the selling pressure in the short dated. There was a big seller at the same time of the buying in the short dated contract on the upside. So it didn't move much, but I would think that it would have had to have gone bid just with the really heavy skew buying. We definitely saw, moving on to I don't want to move on to the beans too early, but I agree with you. And what we'll call that too, with the vol moving up along the smile, is called, maybe a volatility change rate or a vol slide. People call it different things.
Right.
So there's just been a tremendous amount of this week, kind of one-way heavy buying pressure, and then some one-way heavy selling pressure as well. Rather, the buying and the selling has been in bursts, with major players kind of slamming it around. And when we make it into the oil contract, I don't know if we'll talk about Brent or if we're focused on CMA, but we saw some similar, really heavy one-sided action than the other side as well, rather than kind of even action, if you will.
Jared, you hit on it with the beans. You can't really talk corn without talking the flip side. That is the beans. So let's get into that too, because believe it or not, we are running up against it here, and we've only covered corn so far. But there's so much. I bet you a lot of our listeners are like, they had no idea there was so much going on in the ag space. We got you covered here. All the people have been writing in saying, go more into the ags, do a deep dive into ags. Here we are, all this time, just corn. So that should keep you sated at least for a little while. But we're not done yet. We got to get over there into the beans. You mentioned it was a weak kind of end to the week for a lot of the ags products, but still beans also finishing the week up fairly strong, up over about 1.5%, right around that 1060 or so level out there in the beans land. And Jared, you were about to get into some action. You were catching your eye out there in the beans. Why don't you have at it before I dive into what was coming up on our scans for our top 5 out here?
Sure. So for me, what I found super interesting, maybe for your listeners, early in the week, we saw a lot of put buying in the front of the curve. So I had June puts up over June calls, higher than June calls. So the big question is why. We've got some tariff concerns. We saw in the last couple of weeks, China slapped a tariff on sorghum. They're the largest importer of beans, period, but U.S. beans as well. I actually don't believe we're going to get into a true trade war when it comes to soybeans, because they have a growing hog herd. I know I'm kind of jumping between products, but everything's interrelated. So we had this put skew. I found it pretty interesting. For me, I think it's somewhat warranted. It's definitely a genuine fear. And, a lot of people are talking about a bull story with, kind of jumping into the soy meal. I know, getting ahead of myself. But, by the end of the week, we saw the same call buying that happened in the beans, in the corn. So the corn had the July 480s and the 5s, maybe another strike. In the beans, we saw it in the 1200s, the July 12s, maybe the July 1180s. The tool will tell the truth. It'll be better than my memory. So we saw that skew kind of pick up a little bit towards the end of the week, and I think it's possible we ended up on the call skew in the week with all that buying. For me, it was kind of we've got two tails, a bull and a bear. The bear story is, we could shift acres from corn to beans, and really the bull story is coming out of the soy meal. I'm assuming we won't have time for it, but your listeners should Google, YouTube the Panamax vessel that just went right through the port, I think on Wednesday. And so that port represents 20% capacity for soy meal exports out of Argentina, and it's 8% of what's actually exported. They put less than their capacity out of that port. And for me, that's quite bullish, and we really had a run up in soy meal. So that'll make conditions even tighter for our users of soy meal, which kind of lines up with the livestock a little bit. So kind of jumping around, but I don't know if that's on topic or not. You tell me.
Jumping around is kind of what we do here on this show. So don't worry. Speaking of jumping around, Nick, I know you still have some questions about all the vol in corn and indeed in soybeans. So have at it, sir.
No, I just was going to follow up. I pushed out, Mark, I don't know if you retweeted it. I pushed out our quick skew report to kind of show some averages over we do 1, 3, 6, 9, and 12-month averages on the skew, and then show them in comparison to where the skew is right now. And the call skew is right butted up just 0.1% off the high for the call skew. So we're right in line with what we're talking about over the last year for that 25 delta 30 days to expiration option. As far as just following up on what Jared had to say, if you're out on TWIFO, you're going to see that from June, July, August, and maybe a little bit in September, but we definitely had the calls get firmer over the course of the week for the beans. Now, I would attest that some of that has to do with, as Jared mentioned, the vol delta slide or the vol change rate, or the vol slide or vol delta rate. Vol change rate. I wrote delta. I'm reading delta. Vol change rate. So part of it was a little bit of a bid, I think, and part of it was just movement along, in the local volatility of the curve itself. So, and all the put call ratios in the TWIFO are showing. They're all showing to the call side, and significantly for the July, the August, all the way, pretty much all the way through. The only place you don't even see anything approaching even volume in the puts and the calls until you just look at the June contract, and it's 0.97, so it's almost 1. So definitely call buyers there. So that's all supported by the data from a volume standpoint, and the OI is not quite. Stuff is more balanced from an open interest standpoint, but for the first 2 contracts, but then you're pretty for the August and September, the open interest is definitely bent towards the calls. But then again, those contracts are relatively new on the board, I believe, because the open interest on them is pretty small. So that's what we're seeing there. A little bit bid to the calls, vols up a little bit, but I would warrant that's more of the slide like we've been talking about lately. And This is good, Jared. Appreciate it. This is the kind of stuff that we, Mark and I are so far removed from the market making the floor and actual flow that hearing this kind of stuff is just lots of fun.
Yeah, the beans and the corn, they've always had their own rules of engagement too, which is very different from the index world where I used to play, or even the Eurodollar world we used to play. They're kind of their own beast, so it's nice to talk to people who actually spend their days, day in, day out, dealing with that beast specifically. It's always fun. Speaking of the beast and what it was lighting up this week, we kind of talked about some of those setups that are going on out there. Nick talked about the skew. I mentioned it was kind of a bullish week out there for the beans, up about 20 or so handles out there. That all translated into a big boost in OI, about 10.5%. Out there in Beansland, and number one, fun place to visit, Beansland, every now and then. And number one with the bullet out there, again, cmegroup.com/TWIFO. You guys want to follow along with your own reports out there. We're actually, well, the lion's share of the paper, first off, 40% coming in that July contract month, just about 40, a little bit tick under 40% to be precise. But the number one trade out there, actually, all this talk of calls, it was actually the 1020 puts in June that was lighting it up to the tune of 16,000 and change, pretty evenly split between Monday and Tuesday, about a little bit north, about 6,000, about 5,300 on Monday, and 56,000 on Monday, 5,300 on Tuesday. The rest kind of scattered throughout the week. A lot of back and forth, so slightly biased towards opening, but not much at all. So a lot of back and forth on that 10-20 put range. Again, probably as we're flirting with those a little earlier in the week. Followed hot on its heels, number two out there. If you want that call narrative, it was coming in the July 1200s. These are this is an interesting strike as well. About a little bit, shall we say, a little bit out of the money, doing about 14,000 and change. The lion's share, about half of that actually coming today. A little over 7,000 going up today. 6,000 Thursday. Not much left to go the rest of the week, but scattered throughout the week. About 4,000 of that opening. Obviously, we don't know the numbers on today's at 7,000, so it could be a lot more net opening out there on the week. Followed hot on its heels again. Calls getting some love out there, as we alluded to earlier, out there in that July contract with the 1100s, also lighting up a little bit less optimistic. The 1100 strikes doing about 13,500 this week. The lion's share coming on Wednesday, just a little bit under 4,000 going up this week. The rest kind of scattered throughout the week. About 3,400 net opening, so a strong bias to the opening out there. Then we kind of run around the place a little bit here, going back to actually looks like might be 1100s here in back in June with about 8,000 on the tape, 4,000 going up on Tuesday, so pretty much half of it going up on Tuesday, about 2,000 today. Net slightly opening on the week. Again, we don't know the total on today's numbers. And you got pretty much a call strip to, actually, no, I'm sorry, there's puts intruding in there in terms of the power puts. The 1,000 puts out there in June doing about 8,000 contracts out there. The bulk of that coming actually on Monday, about 3,400 going up out there as well. I could keep detailing the top strikes, but we got to get rolling here with the show. We haven't even both finished two products. See, I told you, Jared, an hour flies by when you go deep into the weeds on some of these products. Speaking of some of the weeds, Mr. Nick, I know you got some more burning questions here on all things ag, so have at it, sir.
Well, this is just more of a question for Jared's opinion in general. I know you trade vol, you trade market. You're looking for fair value and edge and that kind of thing. But Mark and I are always sort of curious. Do the if you're talking to customers, I guess how do I phrase this question? We're always. I know you guys don't care which way the market goes, or maybe you have a direction you'd rather see it go from a volatility standpoint. So what's the take on people's thoughts with commodities? Don't we want them to be steady priced and stay in a range? What's that general thought? I know from a trader standpoint, you want it to move around and change and all kinds of uncertainty and that type of thing. But don't people in general, don't you think they want them to sort of have kind of a steady pattern?
Absolutely. I think, and that's one of the reasons that I think the CME contracts on commodities are so important to the world we live in. It allows the end users and the producers. If you're a producer, there's a lot of risk on the table. Let's say you're from Kansas, you should really be planting some wheat. If you're from Illinois, let's say We plant a lot of corn here, for example. You should be able to plant what your competitive advantage is, but you've got this price risk. So coming to CME and hedging some of that price risk allows our farmers to be more efficient, which is a great thing. On the end user side, McDonald's wants to sell their cheeseburger for, whatever it is, $2.99 every day. So they want to hedge their beef risk. They want to hedge the risk of whatever the wheat is in that bun. So they can come to CME, hedge their futures, hedge their options, and take some of that price risk off the table. Why is volatility important? It would be great to live in a world where prices don't move. It's just, unfortunately, we need price rationing to get the right products moving into the right people's hands. McDonald's would never get that wheat to make their bun if they weren't willing to, pay higher than the next price. Maybe that wheat goes into, Smucker's hands. They're one of the largest users of wheat, and they, even though there's a bigger demand for McDonald's. So, rationing is really important. Maybe that example's poor, but, I think a good example is soy meal. One of the uses for soy meal is to feed livestock. It's very important that we end up feeding them or else they will die. So getting that feed grain, get it to the animal is crucial, and it's worth more to the rancher than it is to the end user. McDonald's may say, hey, we're just not going to serve buns today. We're going to really push hard on the salads or, I don't know, the corn dog or something. But the rancher has to feed his animal. They've got a massive investment in it. So price rationing is an important part. I mean, it's Adam Smith, the invisible hand. It's kind of just a part of capitalism and life. So some volatility is important to ration price. Also, if we need more soybeans in the world, for example, like we do now, we see the price of soybeans relative to corn increasing because Argentina had a very poor crop. China, a lot of areas really need these beans. So the price of soybeans relative to corn has to increase as a ratio to incentivize the farmer to produce more soybeans and less corn. So price volatility effectively, creates the right incentives to get food on the table and people fed. It's same thing with energies and, anything else in the world. So it would be great if we didn't have it, but it's a fact of life, and it actually does good. We don't want excess volatility. We don't want fake volatility. We don't want, there are some markets out there where the speculators have taken over and it's, all over the place. But, that's why it's crucial for the end users and the producers, the true hedgers, to be heavily involved in these contracts, heavily involved in delivering them, finding convergence, between spot cash markets and futures markets. And, that's how we have a healthy contract. And a healthy contract is healthy for the world. It's healthy for the economy. It's just an important part of, I guess, a capitalist-based world today.
Yeah, Jared, that's like I said, I want to keep going with this, but we've talked so much about soybeans and corn that we've sucked up most of the oxygen in the room. Not quite all. I do have to get some questions I want to get to in a little bit. So before we do that, I'm going to give you a very impossible task. I'm going to give you like a couple of minutes where you can summarize all of your other thoughts on any other products that are kind of catching your fancy right now. I know you mentioned livestock earlier, maybe a little bit of energy. So if you got any pressing thoughts you want to share on those, we got a couple of minutes left before we have to get to questions. So have at it, sir. The floor is yours.
I'll fire some stuff for you. So, the big deal in soy meal, we'll finish with that in the ags. The last thing that's happening there is the Argentinian peso has been weakening. So Argentina has been purchasing soybeans from Brazil, very expensive for them. They haven't purchased beans from Brazil in 10 years. So this is a very big deal. They're purchasing these beans so they can crush beans. We have very fat crush margins. So they want to crush the beans. We need them to crush the beans. China needs them to crush the beans. But they have a weakening peso, so it's becoming even more expensive than just transporting them. into Argentina. So the Argentinian central bank took an extraordinary step. I believe this was yesterday. They made an unscheduled decision to change the rates, the repo rates, to kind of defend their currency. And that has a lot to do with these commodities trades. So we'll jump from that into, I saw in your notes, you get some livestock questions. So I'll barrel through that quickly. We've seen hogs offered. We've seen cattle bid. Why? Well, the same reason we've got slow planting in corn. It's been, we've got snow and very cold temperatures in the upper Midwest and really across the country. This has impacted the wheat as well, with the freezes in Kansas. We didn't get to that. But for the hogs like it cold. So it's been a tremendous temperature for hogs. They're raised indoors. So they've got, great temperatures at night, great temperatures during the day, and they're just getting really, really fat. So we see a ton of pork, coming to the table each week and each day. So, it's no surprise that the pork contract is, or the hogs contract is selling off because it's just a great conditions for this season to raise hogs. Because they're raised indoors and cool is good. When it's hot, they sweat off the weight. Moving on to the livestock, it's actually the opposite. So the livestock, as we get past the winter and we're moving into the summer, their coats, they kind of shed. And so they were protected with a heavier coat through the winter. But now that they've shed their coats, now that we got snow and freezing temperatures, it's very sad. A lot of the cattle have either received a lot of stress, so they're losing weight, or they've died. So, it's just a sad thing. So it's no surprise we see cattle rallying here over the last week. So that's kind of the cattle hogs. There's more things interesting in terms of the seasonality, especially with the hogs, but we'll kind of leave that there. And then the final thing I'll jump into, I listened to your podcast from last week. We talked a lot about WTI. So I think this is all coming down to this Iranian deal, which is going to happen before the June Brent expiry. The June Brent expiry is really the key one because the Brent is that Middle Eastern oil. And so we've seen the Brent WTI futures arb, if you will, expand from $2 to $6. It's been as high as $20 in the past 5 years. So we're not at extremes, but just talking about how big this deal is, I mean, whatever your politics are, we don't have to jump on them. We'll stick to price. Trump has said this is the worst deal he has ever seen, but, that the French president, Macron, he wants to continue on with the deal. Whether you think it's coming or not, one analyst said to me, this deal, if it doesn't come through, is worth $10 to Brent oil. So he thought, about a week ago, $5 was priced in. So, we're looking for quite some significant price action around this deal. Maybe it gets done early, maybe it gets done late. So those are the major things that I could talk about. Try to run through them quickly. Let me know if you've got any follow-ups.
And we've got a ton. I think we're going to go a little long today because we got a lot of good stuff to cover here on the show. That was all great stuff, Jared. I gave you an impossible task to summarize so many products in a couple of minutes, and you handled it well. Not bad for your maiden voyage here on the old network. Really quickly before we dive into your questions, a couple of big records coming out of our friends over there at CME this week. Copper out there, copper inventory. Don't talk the non-precious metals too often. Hit a record 234,000 short tons back in March. And crypto, I know space, a lot of you guys like to talk about Bitcoin futures record more than 11,000 contracts. Remember, that's a 5x multiplier, so over 55,000 contracts trading on Wednesday with that big move out there. So putting up a lot of numbers out there. And who'd have thunk it? A whole episode of TWIFO goes by. We don't talk crude once. This might be a record here for the show. But what we are going to talk about are some of your questions really quick, because it is time for some of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the feedback portion. This is where you guys take the reins. We had a bunch of people write in before the show, but I got to get to some people in our live chat first. They've been very patient. They were asking questions throughout the show, and I want to make sure they get their time on for their patience. Again, a good incentive, listeners, to join us live. You get bumped to the top of the queue in some of these things. What do we got here? We got T-Mal coming in saying he wants to know, Jared, your opinion on the current speculative interest in corn/beans. He says it seems large right now. He says, what is your opinion on the extremely large open interest? He also said corn open interest in particular is very large. We kind of just talked about that a little bit earlier with these numbers this week, open interest just gapping up sizably over 10% in one of these products out there. So he is onto something. Corn open interest, pretty sizable. Jared, right now, is this something you guys are taking note of? Is this an aberration, or is this maybe what you expected for this point in the cycle?
Sure. So, yeah, I mean, we've got kind of two sets of specs, I guess. We've got that passive, what they call it, the massive passive, which I believe is increasing as we kind of, I kind of just read the headlines that we see some fund managers or retail money kind of cycling from stocks with some of this recent volatility and, kind of firm PE ratios and prices kind of cycling into the commodities. So that is interesting from a long-term perspective. If he's talking about kind of the commitment of traders report released by the CFTC weekly, I actually, what I like to look at is I like to kind of reference it versus long-term averages in the contract. So I see, there's definitely, quite some large longs in the corn, the beans, in particular, as he mentioned. I don't think they're extreme yet. I think liquidity, kind of as we were talking about earlier, liquidity has increased in the space, and the funds are able to move in and out of what seem like very large positions with relative ease. The contract that I was really looking at was soy meal. We've had the largest ever record spec longs in soy meal futures, in the last couple of quarters. And that, that has, that'll change week to week. And they really got on that early, and they were, they got it on that early with the Argentinian weather as it was really dry. They were on it early, and they were on it heavy, and they were right, which is great to see. So the size of the long doesn't concern me. And if you kind of index it to where the funds have been before, they will have a lot less of an impact. I saw the kind of pivoting a little bit in the livestock. That spec interest really increased maybe something like 2 years ago, moving into, the last 6 months. And they pulled out of that market a little more, and I think they got a little big for the market. There's just not as much liquidity there, and I think they struggle to move in and out of positions. So they've shied away a little bit. So we're definitely seeing interest, kind of changing across the board.
Great questions. We're already keeping you late, listeners, but so much good stuff. You guys send in so many good questions. This one from Adam Coker here. I think we kind of addressed this one during the show. He asked, can you explain the nature of options liquidity for the ags? They seem to have a unique trading structure that's focused around the planting and harvesting cycle. Are those the months that generally have the most volume and volatility? I think we kind of broke that down earlier in our in-depth conversation of corn and indeed the beans. So hopefully that answered your question there, Adam. If not, hit us up again. We'll make sure to get into it again. I got a feeling Jared's probably going to be joining us again on the show, so we'll do another deep dive into ags if that doesn't answer your question. All right, we'll have to wrap up on this one. Kind of a fun one, kind of a silly one from BLIO3T. Say that 5 times fast. He or she asking, which products are the ones that you guys have the hardest time wrapping your heads around? He says, for me, it's the hogs. No thanks. I'm with you there, BLIO3T. Yeah, the hogs, the livestock to me has always been those animal products have always been a hard ones. I talked to some guys I remember who left the SIBO and over tried to break into those pits, and these were dyed-in-the-wool options guys who had traded just about every equity and index option product under the sun, and they got into those. And unless you know the flow and the customer base and how those things trade pretty intimately, they have their own rules of engagement. So I'm kind of with you on those. I may also add the dairy and maybe the fluid milk, just because those are also products that I've yet to really be able to fully sink my teeth into and grasp how they trade, because they kind of are some of their unique by appointment type trading as well. So I'd say those two are probably my picks. Mr. Nick, which ones are you? Do you have the hardest time wrapping your head around?
Oh, well, I'm definitely going to go with the dairy, because I still don't really get it entirely. And like I mentioned, every time we do bring it up, the way that presumably the delta changes once you roll the contract into the front month. So how they calculate the delta changes. So whether that's true or not, I don't know. That's what I've heard. But for me, it's probably the fluid milk and the dairy products.
All right, Jared, as our guest, you get the final say here on the matter. I'm guessing you're not going to say the hogs. You may bitterly disagree with us because you actually trade these things on a regular basis, the livestock. So maybe you have a different thought here. What are the ones that kind of puzzle you the most?
Sure. I've been talking a lot, so I'll take a pass on this and just say that I love all the products. I think they're all great, and we definitely struggle in a few places, but I definitely don't want to single any product or especially exchange out. So I'll take a pass on this one. But not everything makes sense to us, for sure.
There you go. I'm gonna put him down as a check mark for the dairy then too. He doesn't have to say it. We'll put the words in his mouth. 3 votes for dairy, a couple for hogs, and all others in between. All right, that music means we've pretty much come up against it out here for the old Twifo show. We kept you long. Thanks for staying late with us. So much. We could have gone for another hour. There's so much good to talk about this week, but we got to cut it off. But before we go, let me go back to my guest here, give him pride of place. Jerry, you talked about a lot of interesting stuff. People want to learn more about what you guys are up to over there at Akuna. Maybe they want to come work for you guys, something along those lines, or they wanted to see what you guys are up to. Where should they go? What should they do?
Absolutely. www.akunacapital.com. That's AKUNA for Akuna. We've got maybe 80 positions open. We're really looking to grow. It's an exciting time in our span as a company. So, we're hiring across the board: developers, traders, quants. Really every department is hiring. So it's an exciting time here. So please feel free to drop your resume, and maybe you'll even speak to me in person. But thanks so much for having me on the show, Mark and Nick. I really appreciate it.
It was fun. I think this was, just judging by the response and all the details we got in some of these products. And again, an area we don't get to focus on a lot, the ags. I think we'll definitely have to bring you back on. I like to hear that too. Hiring 80 people. It's not really a story you hear too much out of the trading world these days, that firms are growing and hiring. Usually it's kind of the opposite. We know after the whole February shakeout in the markets, we saw a lot of firms kind of going the way of the dodo. So I'm glad to hear things are good at Akuna and you're actually hiring. So head on over there. 80 positions, listeners. So head on over there if you're so inclined. Maybe you too get to chat with Jared, not just listen to him on the show here. And Mr. Nick, last but not least, you guys are always cranking out interesting new products, new reports, sometimes at the request of our listeners here on the show over there at Quick Strike. What do you guys have up your sleeve this week, sir?
I think just follow up to last week. Take a look, CME site, cmegroup.com/quickstrike. More good new stuff coming out. There'll be, the expiration calendar tools and the calculators are coming out soon. Also, the events tied to the expirations and soon to be released event volatility calculator. So have a look, and if you got any questions, you can find us at Bantix, BANTIX.com, or search for Quick Strike with no C, QUIKSTRIKE, and options next to it, and you'll find us rather easily. So if you got any questions, just tweet at us, and take a look at the feed today, because I think we put out some good stuff that was in tandem with what Jared had to discuss today. So look forward to the week off, but we'll talk to you in a couple weeks.
Yeah, as Nick alluded to, we will be off for the live show next week. You will get a best of, so don't worry. If you're subscribed, you'll get something fun in your device of choice. We'll keep you covered. And then we'll be back again for the show in 2 weeks here on Friday. So I'll be traveling, Nick will be traveling. So nice little best of next week. Back again in 2 weeks with some fun guests and some other fun stuff. So stay tuned for that. And on behalf of Nick and Jared, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, for asking questions, indeed for staying late with us here on TWIFO this week. It was fun. And we'll see you back here in 2 weeks for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at Bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.